Mark Hamrick, Senior Economic Analyst at Bankrate.com. Thank you for being with us. So we get our PPI print. We see that rise of 0.2% in March. It was less than expected. Comes on the heels. I don't know that anybody cares. And I don't say that, sort of facetiously. It's just that you've had 3 consecutive months of the CPI print, and people think inflation's sticky. What do you think?
Well, we care, don't we, Nicole? Yeah, it's important because inflation's sort of top of mind with respect to the economic challenges that we're facing. And that's in the context of a lot of good things that have been happening with the economy. But of course, inflation, ironically, is the major downer. We wish that prices were not moving up as much as they have been at a persistent rate. And so, as you teased at the top of the program, we're trying to figure out when the Federal Reserve will cut interest rates, if indeed they do. And of course, at the most recent meeting, they told us before seeing the CPI and PPI this week that we should still essentially bet on 3 interest rate cuts this year. But of course, as we've gotten this data, that expectation really has been pushed out now till September, in the sense of that seems to be the greatest likelihood according to those investing in Fed funds futures. And so that's a long time to wait. It's also a lot of data that we have to crunch before we get there. So, the blessing is that we do have a strong, resilient, and robust economy. The downside of that to some degree is that there's still strong demand out there, which is lending support to some of these prices, particularly in the services realm.
Right, understood. So even though this seems to be behaving, right, nobody's going to get some big cut. You're not going to get some cut in June. I mean, it's certainly not going to change the path of what the Fed is thinking, at least at this moment. They're not convinced that inflation is sustainably on the way to 2%. Should they be, or should they be worried?
I think, first of all, our Federal Reserve officials, generally speaking, are willing to be patient and realize that there's no urgency to cut interest rates, particularly when you have a print on the monthly employment report of 303,000 jobs added. So the real question would be, well, why should they rush? And the answer would be they probably shouldn't, and they need to remain where they are right now until, let's say, the federal funds rate is seen as being increasingly restrictive as we get inflation coming down as is expected. If we looked at the variety of economic forecasts that were released by the FOMC last time, they did see inflation easing as we get on through the end of this year and on through next year. But again, it's a situation where not only the Fed needs to be patient, but I dare say consumers and investors, and that's not really what any of us are good at. So, adding to the level of impatience when we see the CPI coming in substantially hotter than expected, and we get an increase in the year-over-year headline of the PPI from what was 1.6 to 2.1, although the core is, in the neighborhood of where it needs to be, and we'll see how that populates the PCE, which the Fed, of course, pays more attention to.
Yeah, understood. When we think about the jobs picture you mentioned, look, we have a pretty tight jobs market at this point. The concern for folks, and I know that most of the people I speak with still think we have a really good economy. I mean, there's still that idea of a hike being thrown around a little bit. There we have, that's the PAX IPO. That's PAX IPO, which is now open trading at $23.25, folks. So that's big news here. Folks are facing bills, big bills. In fact, that's on the cover of the New York Post. It had a drawing of someone with a lot of bills that all said past due. Auto insurance, rent, housing, meals, energy, alcohol, medical care. As you well know, inflation has killed folks. It's really tough. Advice to folks who may have big credit cards now that they're dealing with, and buy now, pay later. I just feel like, are people going to get swamped?
Some are, and some will, and some are using credit to sort of plug the gap between the income that they have and the expenses they're facing. I am really worried about the buy now, pay later space in the sense of people sort of letting that creep into their personal finances at a level where they're not necessarily as aware of that utilization as much as they might be with their credit card statements. And as we go to, let's say, retail stores and they ask us for our personal information, there's always that sort of sell on their part to try to get the consumer to engage in credit utilization there because that's a profit making opportunity for them. It's not necessarily a good opportunity for the consumer when those store rates are on average about 29%. But my point is that people need to be extremely careful about that. The bank rate average on new credit card offers for the best qualified individuals, those with high credit scores, is 20.75%, 20 and three quarters. And we know people who don't have credit scores like that are either being turned down for their applications or getting a much higher rate. The advice that I've shared with you so many times, Nicole, continues to be relevant, and that is prioritize savings, prioritize emergency savings, because what is the major piece of good news along with the resilient and robust economy that's associated with higher rates? It is the opportunity to capture higher yields. And so it's very easy to find a high yield savings account, a certificate of deposit, a money market account that's providing 4 and 5%. So ensure yourself, prioritize that emergency savings. Now is the time to save. We don't know whether we're going to be able to hold on to these highest yields, say, between now and the end of the year.
How about no cuts? What do you think if the Fed did no cuts? Would that be a good idea? Because right now, September's at 70% likelihood when you look at Fed funds futures.
Well, I think that's highly unlikely. Probably something that we should be thinking about. And of course, the Fed hasn't been cutting at its most recent meetings, but officials have been consistent in the sense of believing that inflation will eventually come down, having applied this medicine of high interest rates going back to really more than 2 years now. And, at some point, the economy should continue to envelop these long and variable lags that monetary policy works with. In other words, we know where high interest rates, rising interest rates began to take a toll initially. We saw that in the drubbing that technology stocks and the market more broadly took on. And then, of course, we've had the recovery, rally, and bull market. We continue to see it in housing, where mortgage interest rates, as of this week, according to Bankrate, our weekly average 7.08% on the 30-year fixed. And that's up from the lows of 2.95 a couple or so years ago. And so housing affordability is kind of a nightmare right now. And that's one of the channels that's really been affected by mortgage rates and interest rates where they are. Mortgage refinancing is essentially dead in the water, and it makes it difficult to buy big ticket items such as automobiles, new or used. And we know that those vehicles got a lot more expensive during the pandemic, partly because of supply chain disruptions. And so that does take a toll on households, and people have to be very prudent about not only the purchases they're making, but also the borrowing that they engage in. And this is not an environment that's very friendly for those who want to borrow.
Right. And you said, listen, work on your savings, prioritize savings. Mark Hamrick, Bankrate.com. Thank you for being with us.
Oh, always a pleasure. Well, thank you.